Hopefully my volume is okay. Welcome to our post-election webinar. We got lots to cover, and thank you for joining. Looks like we're going to have kind of a record number, which does not surprise me because obviously this is a hot topic for us to cover. So a couple things housekeeping wise. So let me go through those items first. So feel free to ask a question at any time as we're going through this. There is a Q&A section. Given that this is a political conversation, especially around the election, I want to make sure, please be respectful of the questions. I may not answer, I may not ask them all. Don't be offended if I don't. I want to try to keep this highly productive. Obviously, with what's been transpiring over the last week, it's been a pretty interesting dynamic, obviously. So I want to make sure that we're very respectful. And, you know, one of the things that how I'm going to approach this with reality, like what the results are at this time, what I think that means. It's really tough to forecast any sort of change. So that's really going to be my language. And if things change, we'll be back for another webinar. So I want to approach the reality we are in today, because I don't think it's a good use of any of our time to kind of overly speculate on any potential changes down the road. So let's see here. You guys are all muted. So remember, we're gonna do Q&A, just do the Q&A section. And then also at the end, we will send this via email. We'll also have this uploaded on YouTube. So if you found this useful, please share with friends. All right, so what I'm gonna do now is I'm gonna get our screen shared and we're gonna get started. Okay, so this is all election all the time today. So we are going to put some investment piece to this, but so this election 2020, the results and potential impact on your money. I'm John Vance, president and visionary with Vance Wealth. I am your host and only speaker today, and I'm excited for this topic. There's a lot of moving parts, but it's pretty remarkable that we're here now in November. We've been talking about this for a long time. I think this is roughly our 20th webinar this year. So been a pretty chaotic and abnormal year for everyone. And so today we're just going to cover the election and what we know so far. So here are disclosures. As you all know, Vance Wealth is a registered investment advisor, and the opinions are that of myself. A lot of the slides in here are from Raymond James, Chief Investment Officer. They shared a lot of great slides. So they're the bulk of the content today came directly from Raymond James, but their sources are pretty endless. So a lot of good information came in. And so here's what we're going to do. We're just going to kind of run through some of the items today, really what happened with this unprecedented election. And I know it's not certified yet, but we're going to deal with the reality of where we stand today. The unprecedented election, some of the major stats that we've seen that are really make this an interesting one. And then we're going to jump into kind of the outlook on financial markets and what we think is going to come out of that. So let me have I'm going to use my pointer option here. We'll get my laser. So I'm going to try to just follow along. Some of these I have numbered, so it'll be a little bit easier, but I'm going to read through some of these, probably not all, but voter turnout highest since 1900. And I think that's measured by percentage of eligible voters. Pretty remarkable. Percentage of early and mail-in voting. Over 100 million votes were cast before Election Day. Really remarkable. Record number of early votes were cast before Election Day. Capital spending, 14 billion, right? I mean, what a crazy number that's being spent on our election. And we have some really cool little topics here. Number 5, the sitting party loses presidency, but maintains the control of the Senate. This is only the second time that this has occurred since 1884. Yes, 1884, and the first since 1968. Pretty remarkable. So think of that. I mean, it's such an anomaly of what just happened. This one blows my mind. I have not fact checked it. I think it's, I hope it's accurate because it's good data from Raymond James, but it surprises me. This is the first Democratic president, Republican Senate, and Democrat House. This compensation of the government hasn't happened since 1900. It's so hard for me to believe that is true. But, and I think it kind of picks up on, the number 5 is in terms of a sitting president losing, losing the presidency, but that's party maintaining the Senate. Ohio and Florida go the wrong way. So Ohio and Florida were they're basically predicted the winner in each of the elections since, Ohio since 1964 and Florida since 1996. The stock market got it wrong. So the 3-month return before the election predicted 24 out of the last 24 elections. So we had, a strong market towards the election. That generally bodes well for the incumbent. And then the best start to an election week on records. This is the best week we've ever seen post-election, which is pretty remarkable since at least 1928. So a lot there. I know I ran through that. Those are just more like fun facts, right? This is kind of fun facts around the unprecedented election. Let's see. So some of this, if we look here, strong election week for equities. So this actually, the data point goes back to, I think we're looking at like 1928. It shows you the size of the rally in the stock market or the size of the decline in the stock market. So this represents what we just lived through, the largest rally. And, all the pundits' kind of job is to really tell us, well, why did all this happen? And I think in my humble opinion, the big driver of that was an idea of a split government. And as we look through the data, it really looks to me like this was an anti-Trump trade or an anti-Trump vote, because a lot of Senate Republicans are maintaining their seats, and so it's an interesting dynamic, one that we haven't really seen before. You can see the sectors that did really well. All sectors are positive. Healthcare being a big driver, potentially around some of Biden's policies. And then in terms of, this was really an anomaly where interest rates came down leading up to the election and the stock market went up. And so that's typically not what happens. And so again, did a lot of strange things, but a lot of data points. So one of the things, Raymond James put this slide deck together I believe it was last Thursday. So they have a section on here that Trump victory and Biden victory. So, you guys can read this. I'm happy to send you the slide deck. I'm really focused on moving forward and looking at okay, what does this mean with the likely scenario? So I'm going to go ahead and just kind of cross that off. And we're going to talk about what a Biden victory in Republican Senate. We know that it might not be a Republican Senate. We know that could change, but how we have it now. And I want to kind of deal with what do we think is likely going to happen given this kind of common thread around a split government. So when we look at what it means for growth, what it means for stimulus, monetary policy, COVID policy, U.S.-China relations, what does it look like in a Biden presidency? And I know, depending on the side of the aisle you sit on and who you root for, you're either thinking this is the best thing ever, or you're really depressed. But I'm not here to be your counselor on that. And you can see I'm smiling, so it's a little tongue in cheek. But it's also I want to deal with, okay, what does this mean? Because we're all going to live in this reality. We all need to function in this reality. Capitalism needs to continue to go on. Jobs need to continue to go on. Businesses are going to continue to innovate. And so, and that's the beauty of our country. We'll hopefully have a very orderly transfer of power. So when we look at U.S. growth, we believe under a Biden presidency, recovery is going to continue. We do have a little bit more uncertainty maybe around COVID, the COVID stimulus, right? Because what's going to happen? Are we going to see any stimulus coming in over the next 2 months? And then the one thing that I think the market really liked is the increased corporate and individual taxes are likely off the table. With a split government, tax policy is likely going to remain the same for sure for 2020, but likely for 2021 and 2022 until the midterm elections. And so I think that consistency, I think, is why the market is rallying. But markets do funny things. I can't always predict that. So when we look at that's kind of the growth factor that I still think we're going to stay on a good growth path. And I've been pounding the table on this. If you've been to any of my webinars, I said it doesn't matter who the president is. Now, philosophically, of course it does. We all have our opinions, but from the economy's moving forward, we're going to be fine in either scenario. Now, I am happy that we have a split government because I think that does lessen the chance of policies at either of the extremes, I should say, because I like when we all kind of manage a little bit more down the middle. Given the gridlock in Congress, one of the challenges that we have is when is the package, when is the stimulus going to come, and will we actually get one during a lame dunk presidency? Will Trump actually take some action on the stimulus? I have some slides a little bit later that show that we need some stimulus in place for business owners because we still have shutdown and we're seeing a little bit more of a spike. And so that's an uncertainty. We don't know if stimulus is going to come or if it's going to wait. And if we have to wait, we're almost talking about 3 months before any action can take it, could be taken. And I think that could damage some individuals and some business owners. Monetary policy. So this is a policy that's controlled by the Federal Reserve, likely no change. The Fed has already talked about being accommodative, meaning they're going to keep rates low and try to keep this economy or get this economy back on track. COVID policy for under a Biden administration, probably a little bit more of a heavy hand. I mean, he's talked about more, maybe a mask mandate, different things. So stay tuned. Up till now, it's been left to the states. Under a Biden presidency, that might be, we might have a federal policy. Don't really know, but if we have more state lockdowns or more economic lockdowns, that will definitely have an impact on the economy. But we don't know what the policy is going to be, especially with the news yesterday that from out of Pfizer that there's a vaccine that has a really high percentage of efficacy in terms of, and that was a really healthy sign. One of the reasons why, in our opinion, that the market rallied. But we don't, the devils are always in the details, so we don't know what this is going to look like going forward. And then, U.S.-China relations. Biden will continue to be firm, probably continue to enforce some of Trump's policies in that regard, but maybe more diplomacy, maybe soften, some of the tariffs. Who knows? We don't really know on this one, but nonetheless, we're confident we'll move forward. There's going to be some, there'll be this, even though Biden's president, or even during a Trump presidency, they're surrounded by people that have expertise in these areas. All right. So top priority. I mean, right now we're seeing, there is a spike in COVID cases, so that's obviously causing some more lockdowns in some different places. This chart on the right is kind of why I have this slide up, because I want to talk about this. And so this basically shows that about 24% of businesses are below pre-COVID levels, right? So, there you're seeing businesses where they need help. Their revenue is down, their income is down, their livelihood. And, up and through the end of August, the stimulus package was pretty healthy. We had PPP that was expiring, but people still had money left over. We also saw that, the unemployment, the extra insurance amounts were being paid out by the government through the end of July. And so, but since then, there's really been a stalling of those dollars. And so, if this continues on with more lockdowns, that's going to be a bad combination. So I'm confident we're going to get some of the Republicans and Democrats to work together, but we don't know if Trump is going to allow that, just because right now we are seeing some continued fighting in that. So we'll see how that plays out, and if we're going to move towards, all right, how do we get back on the stimulus conversation? How do we get back to solving things and transition the government? One of the reasons why the market also liked the split government is that Biden did promise to raise taxes for corporations. And, for corporations, for the most of us, it doesn't really apply to us, even though I'm a corporation, I'm an S Corp, not a C Corp. So the raise in corporate taxes was for C corporations specifically. So if you look at this chart here, on the far right-hand side, it shows that if he raised taxes back up to where it was pre the Trump tax cuts, that actually would have a pretty significant hit on earnings. So in a scenario where you can see last year we earned $1.61 on the S&P 500, and then because of COVID we're at $1.34, right? Earnings have plummeted because of the shutdown. We are expecting to have a pretty fast rebound and actually breach these all-time highs that we saw last year. But in a scenario where you had higher corporate taxes, it by definition reduces the earnings. And so that's another reason why the market's kind of cheered this. And again, whether you like it or not, I mean, my job today is that I can't help myself to infer some opinion or to share some of my opinions with you, but it's trying to be somewhat neutral. Like what does this mean? Let's move forward, really looking at it from both sides of the aisle, because I think that's what we're going to need to do. That's what we always should be looking at doing. Again, in my humble opinion. So the good news with that is I think the tax hike right now are no longer a risk. We still have, Georgia and still some states that aren't totally called. So that could change. And if that does change, there's going to be a market response likely, but we just don't know what that outcome is going to be. And unfortunately, that's going to be in January, not now. If we then look at some scenarios, and I think some of the concerns for, let's say, more moderate or Republican were concerned with this kind of blue wave, where maybe a lot more change was going to occur at the government level, and and we know half the country was looking forward to it and the other half wasn't. So it's just a reality of who my audience is. But some of the things that we know, Biden and McConnell have had a good working relationship. They've obviously been, in the Senate essentially for decades. I actually don't know the history of each of them, but I know both of them have been in the government for a significant period of time. And you can look at some of the things they worked on. In 2010, Biden and McConnell worked together to avoid the fiscal cliff, which is where the government was going to have to shut down. There was a debt ceiling issue, worked together to come up with a deal. And so they have some history working together. So that is one of the things we can hope is let's get some of our politicians to start working together on some of these issues. And I know some of you on this are going to cheer this list over here that I had crossing off is, the blue wave policy potentially off the table, eliminating the filibuster, packing the Supreme Court. DC and Puerto Rico is potentially statehood, which would change the Senate dynamic, mandates to climate change, healthcare public option, eliminate the Electoral College. You can't say they're for sure off the table, but it's likely that those items are not on the table any longer. I showed you this last time a couple weeks back. For as much as we all think our party, whatever that party is, as our party is the best party, for the economy, the reality is the data is pretty mixed. And this just tells me, our American system works and we're going to thrive through different types of economic environments, different types of political leaders. You can see going back, and looking at, this is since 1932, looking at just different periods of time. This negative years, this was during presidential election, but you can just kind of see this was during their full term, whatever that full term is. And it's really a mixed bag of, negative years, 13 versus 13, S&P return essentially even, GDP growth means economic growth pretty even. So, this just shows you that, while we are super passionate about what we believe, over a long period of time, it has less relevance. It certainly has relevance in the day, in the minute, in the hour that we're living life. But when we look out over a long period of time, it tends to kind of average out to being good for America in either scenario. The one thing is when we start looking at post-election performance, right? How do things typically do? And so on the right-hand side over here, it says market rallies regardless of election winner. And so we're looking at this light blue as the incumbent win. Well, when the incumbent wins, generally that means that the economy is healthy, which for the most part will mean the stock market's in a good position. And also there's the same policies that we've had in place are going to continue. So when the incumbent wins, there's definitely some more strength. And then when the incumbent loses, there's not as much strength. But in both cases, they're positive. And we know there's been a lot of pessimism out there, and I actually have a few slides later, that I'll cover that. But it's kind of this reason of to be optimistic that we're going to move forward out of this. All right. So I do want to get a little bit specific because I think I've gotten some feedback from many of you that you like when I get a little bit more into the weeds and talk about, certain industries. I can't talk about individual companies, but certain industries. So when we talk about long-term trends and make potential is the key word, political headwinds. So if we look over here, we're going to deal with 4 industries. So infotech, so technology, tailwinds. We likely under a Biden campaign, we're going to get additional fiscal stimulus, which could boost tech spending. We're also going to likely benefit from a potential infrastructure bill. So that's definitely a tailwind, right? More money is going to be put into the system. Potential headwind is antitrust concerns under Biden. We've already seen some of that happening with Facebook and Google and some of these that are, dealing with a high level of privacy issues, potentially more antitrust. Which is not necessarily a bad thing. It depends on how you look at what some of these big companies are doing. And so I definitely think we're going to see this under either administration. Under a Biden administration. We didn't see it much under Trump, but I think at Trump won re-election, we might have seen more of this under him. We might have more regulation in this space. So one of the things is this chart basically shows since 2008. So, kind of right in the middle of the Great Recession. How did earnings in the technology environment compare with the S&P? And you can see earnings, in the tech area far outpaced the regular market. So, the tech space has been such a hot space. You didn't need to hear that from me. We all know that is the case. And that's likely going to continue because we're seeing massive amounts of innovation, and that's not slowing down. Communication services. So what you see down here is this chart on 5G adoption. So what are we seeing in this space? And you can see these are years. So right in the middle is 2020. So you can see very little 5G adoption. And then as we get out, looking out 5 years, 5G becomes a little bit more normal. It's still not the majority in the next 5 years. But we are looking at that becomes a much heavier adoption. And so these are growth areas in the economy. Again, more fiscal stimulus is going to boost the sector. We might see some what would be called like universal broadband or increased 5G spending. So there has been chatter that, everyone should have access to 5G or to broadband, and everyone should have access to the internet. And so are we going to get more government involvement with that? Potential tailwind. Headwinds, increased regulatory concerns. And, we might get some increased corporate taxes, a little bit unknown there. And so you can see here, there's a lot of good tailwinds in this space. I'm going to move to the next slide real quick, but I did get a question. I just want to make sure that it's not regarding, okay, I got a long question here. I'm going to hold this question till a little bit later because it's a little lengthy. So it's a good question, but give me a pause, please. All right. So healthcare. So the healthcare, we likely will see a tailwind from healthcare spending. That's definitely more on Biden's platform, is to pump more money into the healthcare system as a priority. We're going to likely see more federal spending to combat COVID. So those are definitely tailwinds for the healthcare system. The other things that we're seeing is scrutiny on drug pricing. Trump kind of started that. And I'm hopeful Biden will continue, is to really lower our drug prices. Well, it's not great for the pharmaceutical industry, right? Good for individuals, good for consumers. And, a potential public option, when you have one single buyer, they can also push prices down. So there's going to be certain parts of the healthcare system that might not like that. So those are potential headwinds. This chart really fascinated me. So this chart basically goes from 1990 to a projected 2100 or a year of 2100. So we're looking at 80 years from now, based on FactSet. And this blue line at the very bottom shows population below 5 years of age. And then this other one shows population above 65 years of age. So we're right now kind of at this crossroads, right, where we have, our young population and our old population is roughly, there's the same number of the under 5 versus over 65. But look at what happens over, the next 20, 30, 40, 50, 80 years. So that means it's going to be very supportive for healthcare because there's more people living longer, demanding and consuming healthcare. So that's obviously a great tailwind for those industries. Consumer discretionary. So the one thing you think about discretionary, that's how we spend money on things. And Amazon is obviously a big benefactor of that, but more specifically just e-commerce in general. So if you look here, we're looking at, what is the percentage of total retail sale that's in e-commerce. And so if you look at this spike, we went from 16% and we went above 20. Well, we know that's a trend that's going to continue to happen. Even in all of our own households, that's been a trend that's changed. And so the one thing in this space, because of stimulus, because they're putting money in individuals' pocket, or at least they did early on in COVID, more fiscal stimulus into the system. When I say fiscal, that means government stimulus, not necessarily the Federal Reserve. That's going to potentially boost spending. Some headwinds, potential minimum wage hike. That is something that we've talked about, a national minimum wage. If you have that in place, that's going to definitely will hurt more retail related companies because it would hurt margins. Increased social distancing issues, potential that's going to be an issue going forward. So a lot of kind of exciting things. Hopefully you take out of this, there's likely more tailwinds than headwinds. But that's probably just my MO. I tend to be a little bit more glass is half full versus half empty. So there are definitely some positives in these major industries. All right. So next one is, there's a lot here. This has to do with environmental. So we were already seeing a trend towards being more environmentally friendly. Maybe, we're all, I guess, different levels of how fast we want this to occur, but it does take time. And if we notice when you hear politicians talk about it, it's always looking out 20, 30 years because it just takes time to shift our society, to shift our economy. And if you look here, I thought this was pretty fascinating. Going back and looking at different presidents who basically cut greenhouse gas emissions and what that looked like. And so you can see during Clinton's time, you had greenhouse gas emissions go up. Bush kind of flattened out. Obama went down significantly, and then Trump flattened out as well. So obviously the different priority, it's been more of a priority for our nation in the last 20 years. We also have better options. Electric vehicle technology wasn't there. And that's what's pretty exciting about this now, as you look at where we are, total electric vehicles in millions. We're barely even on this radar. Look at the projections going forward, massive amounts of changes. And so that's gonna change the landscape and the need for oil. And it's just it's a path we're heading down. And again, I know some people want it to go faster, but this is a trend that is occurring. And so this number did stagger. It was staggering. By 2040, it's estimated that 60% of total car sales will be of electric vehicles. And so that's obviously a massive shift and a change for that landscape. And one of the things, a lot of people will get focused on the energy sector. Energy sector makes up less than 4% of the stock market, roughly that amount of the S&P 500. So it's less than 4%. So it doesn't have as significant of an impact as it used to. So it's a much smaller portion of the overall stock market. And in certain regions, it's a big portion of jobs, but that's much more local or geographic. Okay, so why we're optimistic. So depending on where you measure our recovery, are we still in a long-term bull market that started roughly in like 2010? Are we 10 years into a really good, healthy market, or are we starting a new one? According to Raymond James and how FactSet put this data together, they're saying we're here. We're in the early stages of the bull market because we had such a terrible sell-off in March, April, and May, or February, March, and April, excuse me, and we're now have recovered from that. But that usually these bull markets or rising markets last on average of up 200%. And based on this math, we're up maybe 50%. So we potentially have a lot longer runway ahead of us. We are also seeing that 76% of the S&P companies actually are paying more income, more dividends to their investor than the 10-year government bond. So that should bode well for people continuing to add money into there. And then this staggering number, $4.4 trillion in money market funds, meaning essentially cash funds. And so we all know that money has to find a home. And those of you who have money in the bank, you're getting paid likely less than 1%. If inflation is running at 2, 2.5, or 3, what happens to the value of your cash? Well, over time, it devalues, right? If you're only earning 1 and inflation runs at 3, you're losing 2% on that money every year. And we know the effects of compounding. If that happens for 3, 4, 5 years, now all of a sudden you lost 10%. So what's going to happen is as we get some level of normalcy and confidence, then we're going to start seeing this cash get put back to work. There's generally an elevated amount of cash, maybe 2 trillion is just normal. 4 trillion is way over historical norms. Also, the fourth quarter of the stock market tends to be positive. And you've already seen that kind of post-election. So just checking my watch, I think I'm moving good, which will give me a little bit more time for Q&A because I got some long questions here. So another reason why we're optimistic. Again, this is another slide, record cash balances. So you can see these crazy numbers, really high cash balances. And what's interesting about this is the cash peak right in the middle of COVID. And this was the cash peak right at the end of the Great Recession. So this is a very normal thing where we see this level peaking. This right here tells me the most about psychology. And we all know that a big part of being a good investor is around behavior, around being having the right investor temperament or being able to follow the right discipline. And what we've seen, so this stat actually shows how much money is leaving stock mutual funds. So mutual funds and ETFs, how much money is leaving. And so that's why it says it's the most unloved bull market. The markets have gone ahead for the last 5 years, but money has been going out. So if you look here in 2013, we saw money coming in, but since then we've been seeing money leave. So what does that tell me a little bit about psychology? Well, we've, as a firm, have, in my opinion, done a good job of, let's say, talking people off the ledge, to use that analogy. We've had an enormous amount of conversations in the middle of COVID, leading up to the election. We were kind of expecting to have a lot of conversation post-election. Maybe with the markets doing well, people will be less concerned, but I know we will have conversations. And so much about this has been about predicting, about saying, well, COVID's going to get worse, therefore the stock market and the economy is going to plummet. I want to get out of the market. Or I don't like what's going to happen with the election. I want to get out of the market. And, you know, what's remarkable to look back on these two scenarios that happened within 8 months is that we went down, we kind of came back up. As we approached the election, everyone was anticipating a potential sell-off, and we've seen the opposite. So what this shows me is that guessing is really hard to do. And that's why we don't try to do that. That's why we take a long-term approach. But this is the data that shows people are selling. There's a lot of people who sold out in the middle of COVID saying, I'm going to wait until things get better, then I'll get back in. Well, COVID hasn't gotten better, but the stock market has rallied from the bottom nearly 50%. So what do you do now if you're sitting and waiting? And so it's just a very dangerous exercise to engage as an investor. It would be like, you know, you thought the economy was going to go down. Would that mean you would go sell your house and rent or move into a hotel? You wouldn't take that approach with the real estate market. Most people wouldn't. And that's a long-term investment. Well, you got to look at your equities as the same thing. It's a long-term investment, a long-term strategy. So just to recoup, I kind of adjusted the slide a little bit here. Split government and Biden wins with a blue wave. Blue wave's not off the table, not likely, really low probability. So these were some of the tax issues that we just wanted to address. So with a split government, tax policy is likely going to be intact for the next 3 years, up to the next 5 years. For sure, the next three, I shouldn't say for sure, likely for the next 3, because of not being able to change any major tax policy. It's also before the midterm elections that could change the makeup of the House and the Senate. So we're likely going to see tax policy stay intact. What's going to change in a split government, we're still going to see spending is going to change, stimulus is going to change, infrastructure, bills will change, but the tax side of things are likely going to stay consistent. So given that, we want to be really proactive with our clients and making sure we're doing what we can over these next 3 years, essentially, to make the most wise decisions around tax strategy. How do we position ourselves to minimize taxes over our lifetime? And so that could be for our kids if we're doing estate planning. It could just be for our own retirement, whatever that might be, is really be in tune with all the tax changes and understanding the tax code. And that's a big part of what we do, working with our clients, also working with their tax professionals, because that's a big part of it. We don't do it alone for sure. If Biden wins, we talked about this, unlikely, but just because I know a lot of people were freaking out, this is going to be devastating for everyone. I mean, it was really tackling above 400,000, which is deemed the 1%. So the highest 1% of earner. They were going to be higher tax rates, in some cases fairly punitive to my estimation, but this is not likely. And so don't let this scare you that if you think that Biden and there might be a blue wave, that, if you're making 100,000, 150,000, 200,000, you're not going to be impacted from a tax policy. Tax policies might impact the economy, but it's not going to impact your taxes. And I think there's been maybe a lot of, I don't want to say misinformation, but that's something that I think was a little bit, a little bit of a scare tactic there. So if that was the scenario, one of the things that, we were talking as a team is that we like to be proactive. And so as we were going into year end, if the possibility was we were going to have control with basically one party, we would likely want to take more income in 2020, whatever we could, through taking gains, meaning selling stuff, taking profit, forcing money out of our IRAs, doing Roth conversions. That was going to be a big part of our year-end strategy. So we're a little bit stuck now, because if we don't know for sure till January what do we do, right? Because we're looking at this saying, do we make a decision in December that might pay off in January or might not? And so the idea of realizing a bunch of taxes this year to avoid future taxes is a little daunting when we don't know if this is a certainty. And so it's really going to be handled on a case-by-case basis and really kind of going through and having a better understanding. But that's the unfortunate part for us, that the Georgia runoff is not going to be until January, because it doesn't allow us to position and help clients make better decisions as we go into year end. But again, the likely scenario is that it may be not going to matter. But again, that's really going to be an individual conversation. So if we can help with that, please let me know. This is just the reminder of getting back to the keys to managing your investments. One of the things that for investors that have accumulated a decent amount of money, they've kind of grown to despise volatility, meaning they see their $2 million account lose 30%, which is, let's say 25% during COVID. So that's $500,000. That pain of that severe loss causes people not to be a long-term investor. And so, and I think what happens is when you start off investing, you're starting off with 50,000 or 100,000, you build to $1 million. As you get hit with volatility, it gets more and more painful. You start pushing up into higher levels of 3 million, 5 million. Now that volatility becomes a really large dollar amount. And I think just having faith in being a long-term investor, embracing volatility, understanding that's part of investing. That's almost like the price you pay to be a good investor, is you look at volatility and you say, I'm going to own this. I'm going to be okay with it. Even though when I look at my statement and it lost this amount of money, I know that that's a temporary engagement, or at least it has in our history, unless you think we're going to go into a decline for the next 20, 30 years, which I just don't believe we are. The one thing that we know is happening is the government is pumping a lot of money in the system. They're probably going to create some inflation. And what tends to do well in that environment? What's known as risk assets. Risk assets would be real estate and stocks. And it's not all real estate, and it's certainly not all stocks, but as a basket. And so I really implore you to embrace volatility. And if you're younger and you're still saving, you love volatility. That's how you build wealth, because you get to buy stuff when they go on sale. Retirees have a little bit of a different kind of love-hate with volatility, because they don't have a way to earn money again, right? They've turned off their paychecks. And so volatility is a little bit tougher, but that's what we're here to help with. So embracing volatility is a big one. Avoid market timing, staying invested. So my advice here is the new one I added here: stop trying to predict the future. I can't predict the future. I have opinions, but I can't predict it. And you can't have an investment decision that just starts to bounce around and kind of following following my laser pointer here of like, where's it going to go? You just don't know. And so we cannot make investment decisions based on guessing. We can't make these decisions based on trying to predict or out predict. And I think that's what happens. People try to out predict, thinking I'm going to be smarter. Well, I know this presidential election, this is going to happen, and I'm going to make this decision. And then what happens is maybe that outcome occurs, but the markets don't respond like you think. And so stay invested, stay to your plan. So when you build your allocation strategy, understand your target return. That's why we do financial planning. What is the number I need to earn to reach my financial goals? Is it 2%? Is it 5%? Is it 8%? Understand that number. And then from there, understand how much you're going to spend. What kind of cash flow do you need? Because we all need to live on some source of income, whether it's from working or from our investments. Understand what that looks like, plan for it. One of the things that we had a heavy conversation with clients at the start of COVID was, all right, do we have enough cash and do we have enough safe investments so that if this gets protracted, we didn't know the government was going to come in and bail us out. We had a sense that they would, but what if they didn't? Did we have enough cash? Do we have enough safe investments? That was something we were keenly aware of for our clients. Then understanding your risk tolerance. A big part of embracing volatility is you got to understand, can you stick through it? And now we're having a transition going from a Republican president to a Democrat president. Those of you that are not Democrat are going to have a much more negative feeling about the future of investments. We had the same, I've been through these transitions, when Bush won, when Obama won, and when Trump won. And in most cases, the markets did well during those presidencies. And so it was a little bit unfounded. So just kind of the advice to you is this should be based on your own plan. The political landscape we can't control. We're never going to be able to control. It's something that's with us. But you can control your actions. You can set your plan. You can set your goals. And then monitor and rebalance. It's our job to stay on top of things, keep your portfolio aligned, and stick to the plan. So, and I'm going to get to the questions because I know there's likely a couple building up here. Most people don't have a plan. If you know anyone who could benefit from more thoughtful planning, especially in the area of taxes, please connect us. We do think we can make an impact in most cases. So you guys all know these are our core values of our firm. So I think I'm going to leave these up and look at some Q&A. So I'm happy to answer Q&A, keep it friendly, because I know political dialogue at times can be challenging. So bear with me for a second. This is a long question. I want to make sure I understand it. I don't want to read it without really understanding. Okay, so this is a question around Prop 19. So Prop 19 in California passed, which basically allowed homeowners to keep their current property taxes, even if purchasing a significantly more expensive property. Have you looked into this initiative? And there's some more questions in there. So let me kind of address that. So I think Prop 19 did pass. I'm certainly not an expert in this. I think I had a challenge with Prop 19 because it did allow people to carry their property taxes, but it did not allow them, if a child inherited the money and didn't live in there, then their property taxes couldn't carry. So for whatever reason, I did not support it. But the question that you're asking me is there are truly no changes in the property tax rate. There are no changes, I think, for that transition if it's your property, but I do think there is an impact on the next generation. And so there are some like hidden challenges in there, but it passed. And so there was already some protection in place to allow people to carry their property taxes. I think you could only do it once before, and now you can do it more often. But again, I'm not an expert there. So hopefully that made a little bit of sense, excuse me. So here we go. We got a good question here. With the transition to a Biden administration beginning on January 20th, do you believe that it makes sense to pull money out of the market? Right. So I think this question might have come in before I kind of got into my advice. And if so, would your general recommendation, what percentage to withdraw? So, given kind of the financial plan, I think that, it all comes down to your financial goals. Most of our clients, whether they're, still working, newly retired or retired, many are looking at, long-term investment decisions where they might live 10 years, 20 years, 30 years, 40 years. And so the danger with pulling out to miss some of the downside is if you get out of the markets, when you get back in, you have to get back in right. You have to get back in at the bottom. You have to get back in, and so you have to get it right twice. You get out, and then you have to know when to get back in. And it's just very dangerous. And we know over time investments do well, at least they historically have. And so just staying the course and kind of riding through these it doesn't always breed the best results, but it breeds the most consistent results. Because we can't predict the future, it's better to ride through these and stay invested than to try to figure out when to get in and out, because you're bound to be wrong. I already gave you a great example of that. The person who lost 10, 15% in COVID and then got out and was waiting for COVID to disappear or get better, they're still waiting. And so, that's return that you miss. If you miss on a 10-year basis, if you miss a 10% rally in the stock market, that permanently reduces your rate of return. And so that's just the challenge. Now, the other part of it is for many people who believe this is a really negative thing for our country and for the economy, there are ways to be proactive. We can look at this and saying, okay, do we need to revise your goal? Do we need to revise your spending? If you want to get more conservative, okay, how's that going to impact your financial plan? And in some cases you might say, hey, I'm willing to actually spend less money and do less and take less risk because it's going to help me sleep at night. So if that's an emotional decision, we can have that conversation, but that factors into planning. It's not just I want to get out and get back in, because that's a really dangerous, thing to try to do with any degree of, success would be my advice. So I know we had a lot on here. I'm happy to entertain any more questions. I did answer the few that I did get. We had over 50 participants, so I'm happy if anyone has anything else. But I think that we're going to go through. It's going to be kind of a little bit of, I guess, a gray area. Maybe is the nicest way to put it, until this gets finalized and until we get, I guess, certified the election. But I don't want to say in either case, because I think we know the path that we're heading down. Even though I know I've talked to people where they're like, it's not over yet. But from my perspective, I think it would do more damage to try to undo this, because anytime either party feels like they got an election stolen, and I know the Republicans feel a little bit of that, is that it creates even more division, and we have so much of it now that it's kind of like, I guess in my opinion, it's like, hey, let's move forward, whatever the results are. And those are things as citizens we have to deal with constantly. And we've all lived through different changes of power, and we've all prospered. So that's the confidence, that's the faith that I have in our kind of American way of doing things. And you would be hard pressed to convince me otherwise. Looks like I do have another question. Someone asked, will this recording be available? Yes. So if you're on this and you're on our database, we will be sending out an email. If you got this from a friend, let's say, or you referred in, this will be available on our YouTube channel, generally in a day. And the other question was just a comment, said thanks. So hope you enjoyed. We will be doing our next webinar. I do think it's December 15th, which is the third Tuesday of December, and that'll be our last one for the year. If there's any major things that happen, which I'm not anticipating, we might come in and do another webinar. But the one thing that it's going to be on, it's also going to be on our website. The one thing that I would really encourage you, if there are topics or things that you want me to cover around, just personal finance, taxes, planning, investments, please don't be shy about asking. We're here to deliver information. I've really enjoyed this. I mean, this year doing COVID, but being able to do over 20 webinars, being able to connect with clients has been great. So I have been coming to work, which, I've really cherished. And we feel very lucky with that as a company. We've been able to serve our clients. We've been able to continue to work and kind of keep me mentally strong, because I don't think I would function well without being able to be productive and work. So we feel very fortunate there. And we're here to help. So thank you all for listening, and you all have a great night. Thank you.